They said we learned our lesson in 2008. That the reckless lending, the hidden risks, and the bubbles had been buried for good. But beneath the shine of new cars and easy credit, another ticking time bomb is quietly building, one that could explode without warning. Because this time, it's not homes being gambled with. It's cars. And once again, Wall Street is driving full speed toward a cliff. This is the story of the subprime auto loan bubble, the hidden engine of debt powering America's illusion of prosperity. Owning a car has always meant freedom. For millions, it's the symbol of independence, success, and progress. But what if that freedom was financed by a lie? What if the very system helping people get behind the wheel was designed to make them crash? In 2024 alone, Americans owe over $1.6 trillion in auto loans. The highest in history. And more than 1 in 4 of those loans are subprime, meaning they're issued to borrowers with poor credit, unstable income, or both. The same risky strategy that once collapsed the housing market is back, just with shinier rims. To understand today's bubble, we have to rewind to the ashes of the 2008 financial crisis. Banks were shattered. Trust was gone. The housing market was toxic. So, Wall Street needed a new product, something they could package, sell, and gamble with again. Enter the auto loan. It seems simple. People always need cars, and cars, unlike houses, depreciate quickly, so people keep paying to avoid repossession. That predictability made auto loans look safe. But when traditional borrowers dried up, lenders found a new gold mine. The subprime market, people desperate for wheels but locked out of prime credit. Just like the housing bubble, it started with compassion and ended with corruption. Between 2010 and 2019, the auto industry made a discovery. The more they lent, the more cars they sold, and the more loans they sold, the more profits they booked, even if the borrowers couldn't pay. Car dealers and finance companies teamed up. 0 down payments. No credit, no problem. Interest rates of 20%, 25%, sometimes even 30%. And behind the scenes, these risky loans were bundled into securities, called asset-backed securities, or ABS, and sold to investors around the world. Sound familiar? It should. It's the exact same playbook used for mortgage-backed securities in the housing crash. Soon, Wall Street was making billions again. Only this time it wasn't suburban homes being flipped, it was used cars. By 2023, cracks started to appear. Repossession rates skyrocketed. Delinquencies hit record highs, with over 7 million Americans behind on their car payments. Some borrowers were paying more for their car loan than their rent. A $20,000 used car could end up costing $40,000 after interest. And yet, the lending didn't stop, because lenders weren't keeping the risk, they were selling it off. Just like before, the profits were privatized, and the pain socialized. The average loan term stretched from 4 years to 7, even 8. People were paying for cars long after they'd lost half their value. It was unsustainable. But as long as the money flowed, nobody cared. By mid-2024, a quiet crisis began unfolding in parking lots and driveways across America. Tow trucks started working overtime. Repossession companies were overwhelmed. Used car lots filled with vehicles owners could no longer afford. But what truly broke the illusion was this. Even as borrowers defaulted, investors were still being paid. How? Because the system was once again rigged on borrowed time. Ratings agencies stamped risky securities as safe, and the Federal Reserve's low-interest policies kept cheap credit flowing like gasoline. But when rates began to rise in 2022, everything changed. Borrowers who once paid $400 a month were now paying $700 or more. Defaults soared, and the safe subprime bonds started cracking under pressure. It was terrible, but nobody wanted to say the word crash. Regulators promised oversight. Lenders promised reform. But history tells us promises don't pay the bills. Instead of ending risky lending, the market evolved to hide it better. Fintech startups began issuing instant car loans online with almost no verification. Some companies even used AI to approve high-risk borrowers, making decisions in seconds. Meanwhile, Dealerships kept inflating prices because cheap loans made expensive cars affordable. It was a cycle built on illusion. And when it all starts to unwind, it won't just be car buyers who suffer. It'll be the investors, banks, and pension funds holding billions in auto-backed securities. The subprime auto bubble isn't an isolated story. It's part of a pattern, financial déjà vu, that repeats every decade. In the early 2000s, it was houses. In the 2010s, it was student debt. Now, it's cars. Each time, the formula is the same. Make credit cheap and easy. Package debt as an investment. Pretend the risk doesn't exist. Wait for the bubble to burst. And when it does, millions of ordinary people pay the price while the system that caused it survives untouched. It's not about cars. It's about confidence, and that's what's truly running out of gas. Behind every statistic is a story. A single mother paying $650 a month for a 10-year-old sedan. A gig worker using his car to survive until repossession takes his livelihood away. These are not bad borrowers. They are victims of a machine that profits from desperation. The lenders don't care if you default, they've already sold your loan. The investors don't care if you fail, they've been paid. And the system doesn't care, because it's designed that way. In the end, the car may be gone, the loan unpaid, but the debt still lives on. Economists are warning of what they call a credit shock. As more loans default, the securities backed by them could lose billions in value. Banks could tighten lending, car sales could plummet, and just like the housing market in 2008, a chain reaction could ripple across the economy. The warning signs are already here. Used car prices falling, delinquencies at a 20-year high, and auto lenders quietly filing for bankruptcy. But unlike before, this bubble isn't big enough to bring down the global system, just enough to break millions of lives. So, what are the lessons from this road we've traveled? 3 takeaways. First, debt is not freedom. Easy credit may promise mobility, but it often traps people right where they are. Second, history rhymes. Every bubble begins with good intentions and ends in quiet ruin. And third, the system adapts, but never reforms. It just finds new markets, new borrowers, and new excuses. The game never stops. The subprime auto loan bubble isn't the next 2008. It's a warning shot that we've learned nothing from it. And as long as greed drives finance, the next crash will always be coming. If you found this story eye-opening, don't just drive away from it, learn from it. Share this video, because history doesn't repeat unless we ignore it. This is Shadows of History, revealing the stories the world forgets until they return. Thanks for watching, and be sure to subscribe for more.